Okay, in this segment, we're going to talk about the head and shoulder pattern. There are actually two patterns. It's a head and shoulder top and the head and shoulder bottom. Both of those patterns are trend reversal patterns. They're just a little bit more difficult to recognize initially, but once you train your eye to recognize them, you'll see it's actually pretty easy. So what I want to do here is we're going to highlight, or draw out, I should say, head and shoulder patterns. We'll talk about entries as well. So let's do that. Let's just get rolling here. So let me grab my pen. All right, so what we're going to do initially here is we're going to talk about the head and shoulder bottom pattern. So the market's moving down, and what happens is the market stops, puts in a low. Much like we see when a number one point of a 1, 2, 3 bottom forms, or the first stop of a double bottom forms. However, the difference here, the market will rally and then roll back over and resume the prior downtrend and even break below that low. Okay? And then it stops for whatever reason. There could be support down there. There's a lot of buyers down there, whatever the reason might be. So what we have at this point is we have 2/3 of the head and shoulder pattern. This area right through here would be a left shoulder. This area right here will be the head. We have left shoulder and the head. Now the way you can help yourself visualize this pattern is just imagine someone standing on their head. Okay, so we have that so far. All right, so from there, the market rallies, stops, and then rolls back over again, heading back towards the head, and then halts somewhere. So now we have a right shoulder. So a left shoulder, a head, and a right shoulder. What I also want you to notice, though, 1, 2, 3 pattern inside the head and shoulder. Keep in mind, these areas that form the shoulders and the head are still, or pivots, right? So they are support and resistance levels. So a shoulder here, for instance, over here like this left shoulder, we might see a candle like that, and then we have another one like that, and another one like that. That is going to be the point of the shoulder right there. Same over here, wherever that happens. Sometimes you may even have equal lows on several candles. So it's a grouping that causes or forms the shoulder. Same on the head. What we want to do is we want to look to get an entry near this right shoulder, somewhere after that right shoulder is confirmed. One of the old school way that traders would trade this pattern would be to draw a neckline between the two peaks of the inversion portion of this pattern. In other words, you see this peak right here between the left shoulder and the head right here, and you see the same sort of thing between the head and the right shoulder. So we draw a trend line connecting those peaks, extend it out, and then traders would wait for that line to get broken before an entry takes place. I don't want to do that. Early entries, right? Getting on board before the rest of the crowd does so we can reduce our risk. And that's really the big key here. So if we get on board, say right here, and we put our stop below that right shoulder, that's our risk box. Or we could even put it below the head, right? So if I put it below the head here, my entry is at the top of the box, my stop loss at the bottom of the box. Now, let's compare that to an entry. Let's say the market ends up breaking the trend line up here, right there. So now I'm going to get on board over here. So now my entry's here, and what if I still want to put my stop down there? So see how I've increased my risk by maybe half to a third to a half. So we want these early entries taking off half your position by the time the others are just getting on board. And those others that are stepping in to buy on the break of the trend lines, etc., they are the ones that are, they have a higher risk, right? Because what if the trade fails? we're already on board. We've already taken profits maybe. All right, so on this chart, we have to keep in mind we do have support and resistance levels. So like right here, that shoulder is a resistance level. Oh, look at that, it's just broken right there. This is a resistance level as well, just horizontal. And then we also have that angle trend line drawn. Support down here, right? Support down here. So that's an inverted head and shoulder pattern. Just imagine someone standing on their head, and the angled trend line that I drew here, let me change the color of that. Just talk about that a little bit more. This one right here, that is considered a neckline. If you just think of a line drawn, the person's a little bit crooked, right? Maybe they're doing their handstand on part of their shoulder. One of their shoulders is up on a couch or sofa, and the other one's on the floor. So they're a little bit discombobulated, and you're just looking at basically their armpit areas. Okay, so we're looking to trade that to the upside because the trend has been down, and now because the formation has developed, we're looking for a trend reversal. Okay, so that is an inverted head and shoulder pattern, also known as a head and shoulder bottom pattern. Now, one thing to keep in mind, the pattern again develops in any time frame and in any market. It's universal. Now, that is an asymmetrical head and shoulder pattern, asymmetrical head and shoulder bottom pattern. What I mean by that is the right shoulders are not even with one another. So let me draw out a symmetrical pattern. I'm just going to put it up here. So the market moves down, forms that right shoulder, or sorry, the left shoulder, now forms the head, and maybe it does something like this. They're not always going to be perfect, but now you have these shoulders lined up here. Shoulder, head, shoulder, and if I was to put a trend line on this, those are pretty even. That is a symmetrical head and shoulder bottom. Many times you'll have these peaks here in between the shoulders. They'll be very, very even with one another as well. When you were to draw, if you were to draw a neckline. Again, I don't use the necklines. We don't take those into play at all because we're looking to get on board if we enter a trade inside that right shoulder. That's the key. All right, next, I'm going to show you the head and shoulder top pattern. It's absolutely the same thing. It's just inverted from the inverted pattern. Okay, so let's do this. Let's draw this puppy out. So the market rallies, puts in a high, pulls back. Maybe it bounces off some support that we can't see on the chart at the moment, but it bounces and it rallies and then breaks above that high and continues higher. And then for whatever reason, it kind of stops and pulls back and even breaks that low, but then rallies again and kind of stops right there. So that is essentially a symmetrical head and shoulder pattern, a symmetrical head and shoulder pattern. Because if you look at the shoulders, they're pretty much lined up. They're really close. To me, that's close enough. It's kind of like hand grenades. All right, it's close enough. It's going to do what it needs to do. All right, so here we have the shoulders. So we have a left shoulder, we have a head, and we have a right shoulder. And the right shoulder just formed, as you can see how price kind of hooked over there. And again, in this case, if we were looking at actual candlesticks or price bars, we're going to see something like this as the market moves up to form these peaks. Remember, we all have at least one, and a higher one, and a lower one. So that right there is, of course, the shoulder. You could call the whole grouping, but that pivot is what we're looking for. And again, that could occur with multiple candles, even multiple price bars. Maybe there's another one here that's got the equal height to it, you know, right through there. So again, we're looking for entries inside the right shoulder once it's confirmed by hooking over. Price starts moving lower a little bit. And at this point, if we were going to trade this, for instance, if we got our entry right there, boy, we could even put our stop just above that right shoulder, correct? We could do that. That's very low risk. Or if we needed to give it, it's all relative, of course, to the time and price and such, but we could put it up there above the head. So let's do that for this example. But remember, old school is going to do it different. Old school is going to wait for price to break the neckline right through here. So with that in mind, this would be a typical risk box for old school, right? So we could say from here to down here, wherever, if they were to get in just below that line I drew. So look at that, that's double. I think that's pretty accurate. That's double the risk. So think of this, and this is the very, very important part of the methodology using patterns like this, is that when we get filled right here on the smaller box, right there at the bottom edge of the smaller red box, and the market moves down to here, once it's there, where these folks are getting in, we already have a profit. We already have a profit, and they're just getting in. So that's the beauty of it, trading it this way. Now, the downside, of course, is what if you have a misread and then the market continues on up and stops you out and this guy down here never gets in? Yeah, that is a possibility. So that's a symmetrical head and shoulder pattern. So now let's come back over here and draw an asymmetrical. So very similar to what we did with the inverted pattern. You have a shoulder, a head, and maybe the right shoulder forms up here. So you can see how price is higher here. So that is the asymmetrical. So shoulder right there, head right here, shoulder right there. And again, don't use the necklines for entries, just reading the price action within the pattern itself. Okay, so just a reminder, these patterns are trend reversal patterns. The market's been trending higher and all of a sudden it starts to get weak. Profits are being taken, whatever the reasons being, we're just trying to visually train our eyes to recognize these price patterns. They can occur again in any time frame and in any market. So from a 20-second chart to a monthly chart. And it could be in corn and it could be in Amazon stock. Doesn't matter. You'll see these time and time again. That's the basics of the head and shoulder bottom and the head and shoulder top pattern.